What's going on, traders? Welcome back to the Trading Dad Chronicles. Glad you guys are here today. If you followed our last two analysis the last couple of days, you have just absolutely killed the market today. As you can see, our NASDAQ chart here, it followed us right on down to all our levels, and it was an excellent guide to where we're going. And you just made buku bucks if you followed this, guys. I hope you guys are starting to see the relevance in this and seeing how important these things are. So what are we going to do today? Well, let's take a look at the market and see what exactly we have now. All right, so today we're going to talk about the dealer positioning report. So we're going to be covering a significant shift in the market structure that demands a complete update of our key levels and dealer map. We'll break down the mechanics of this change and what it means for tactical execution. This report provides a concise overview of the current market landscape. We'll focus on the implications for dealer positioning and volatility. Let's dive into the specifics of this market transition. The market has undergone a significant structural shift. We've moved from a bullish positive gamma environment to an unstable negative gamma regime. This transition follows the decisive failure of the 29,300 dealer pivot and the loss of the 29,232 responsive buyer shelf. This means dealer hedging will now amplify price moves, not dampen them. We expect unstable rotational behavior and increased volatility. Now, let's look at what triggered this breakdown. Today's sell-off was structurally important. Price lost value quickly, with failed reclaim attempts being sold aggressively. The trend accelerated directly into the put wall region, a classic sign of dealer dehedging. While we saw a bounce from 28,800, it's not a trend repair. This indicates an inventory unwind, where long gamma positions were liquidated. This behavior removed volatility buffer. This shift has significant implications for the future volatility to come. In this neutral to negative gamma state, we face an elevated risk of volatility expansion. Expect larger intraday swings and faster reversals. Failed reclaims now offer high probability short opportunities. This market has shifted from a buy the dip mentality to a sell the rally, rotational volatility regime. Vanna and charm effects will amplify moves, forcing dealers to sell more futures. This negative feedback loop will increase price instability. So, where are the key levels for the potential repair? These are the critical resistance zones to watch for any potential structural repair. The 29,190 to 29,230 range is the first major reclaim zone. The 29,300 dealer pivot is the most important institutional control level. Until we reclaim this level, downside pressure remains the dominant force. A move to 29,500 would signal a full structure recovery. Beyond that, 29,600 acts as a major dealer resistance. Next, we'll examine the downside targets and acceleration triggers. Now, let's shift our focus to the downside and identify critical support targets. These levels represent key defensive zones where we expect responsive buying or conversely triggers for accelerated downside. We're looking at the 28,975 as our current active put wall. A crucial support floor below that 28,850 acts as a gamma expansion trigger. A break here could significantly increase volatility. And then we have the 28,700 as our first major weekly downside target. This is a critical area to watch for any further breakdown. From these support targets, we now move on to the significant structural shift in our dealer map. The 29,300 level has undergone a critical pivot conversion, shifting its role entirely. This level, previously as a support, is now a major resistance pivot, dictating the institutional bias. Above 29,300, we could see structural repair and continuation. However, below 29,300, downside pressure remains the dominant market regime. This 29,300 level is now the key institutional control level for the session. This pivot conversion leads us directly to the most important intraday zone. This specific zone, 29,190 to 29,230, is our primary battleground for the session. It was a prior support shelf, but has now converted into a major resistance battleground. The overnight stability saw the bounce stabilize exactly in this region, confirming the importance of this region. This is also the area where dealers are most likely to adjust their inventory and delta hedges. This zone will likely set the tone for the entire session. Now, let's consider the highest probability scenario given these new levels. Our highest probability scenario currently points to a bearish extension. This will trigger if NQ rejects 29,190 to 29,300 resistance zone. The path would then be 28,975, then 28,850, and potentially down to 28,700. A significant risk lies below 28,850, where hedging could accelerate to the downside very sharply. This could lead to fast liquidation and a significant volatility expansion. Next, we'll outline the requirements for any structural repair and recovery to the upside. After discussing the highest probability bearish scenario, now we turn to what would take for the market to repair its structure. For any recovery to be credible, buyers must first reclaim 29,230 shelf and then decisively take back the 29,300 dealer pivot. Until these levels are firmly held, any rallies are likely just inventory adjustments, not true trend reversals. A sustained move above 29,300 would force dealers to cover shorts, potentially triggering a significant short squeeze to the upside. This brings us to our tactical framework for navigating these conditions. Building on the repair requirements, our tactical framework outlines high-quality setups in this environment. The best short opportunity arises from a failed reclaim of the 29,190 to 29,300 resistance zone, especially with weak delta and expanding volatility. Conversely, a long setup requires holding the 28,975 put wall and reclaiming the 29,190 level. Without the reclaim, longs are counter-trend scalps only. We must also monitor inter-market signals, as a spike in a 10-year yield or the USD dollar will likely cap any NQ rally. This framework helps us understand who maintains control in this market. In summary, the institutional read is clear. Sellers maintain control in this rotational volatility regime. The market has shifted from a buy the dip mentality to a sell the rally environment. We should expect larger swings and faster reversals as long as gamma remains negative. The 29,300 dealer pivot is the critical level. Until it is reclaimed, the bearish bias will persist. Always respect these levels, as dealer positioning is the primary driver of price action in this fragile state. Once again, guys, I hope you guys followed along. You enjoyed this analysis, and I hope you use it to your benefit for tomorrow's trading session. I'll see you guys tomorrow, and you guys have a great one.